Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is a new guest to the show, Jeff Clark. He's Senior Analyst for goldsilver.com. How are you today, Jeff?
I'm doing great, Tom. Thanks for having me.
It's a pleasure to have you. I thought we could start. Why don't you share with us a little bit about how you got into the gold industry?
Yes, so my family and my father owned mining claims, actually, all over California, Arizona, Nevada. He retired early, moved to California, and got bit by the prospecting bug. So he that became his full-time job, and he really got into it. He got pretty good at it. He actually won some gold panning contests. Yes, there are such things. And he got so good at it. He was part of this group that when you bought a new metal detector, they would guarantee that you would find some gold with it when they took you out to show you how to use it. So he got kind of good at the game, right? As a prospector, nothing on a big scale like you'd find with a junior miner or something like that. This is more just personal prospecting with him and his team. But I picked up a lot from him, obviously. I didn't quite get into the gold panning as much as he did. It, can be long and hot and hard work and going over roads that aren't paved and that sort of thing. And it's kind of like fishing. You never know what you're going to find, right? You don't know how long it'll take you or if you'll find even anything. So that's all gold prospecting can be. So my interest really turned more into investing and making money with gold. And I eventually hooked up with Casey Research and went under the tutelage of Louis James there. And so he was kind of my mentor. I mean, I learned from everybody there, including Doug Casey and Maren Katuza, but Louis was the real one. I really went to the next level in my understanding of the mining industry. So,
could you share with us a couple lessons that maybe you've learned from your time at Casey Research and Louis, or even from Mike Maloney as well?
Sure. So Casey Research for quite a while, and like I said, worked under Louis. Louis is great. He's very straightforward. Most of what I learned came from him, and his mentor he learned from Doug Casey himself. So it kind of passed on down the line there. And I think with Louis, the one thing I learned so much, right? It'd be hard to quantify it all, but the one lesson I really picked up from him was to learn to be skeptical. The old Mark Twain quote, a gold mine is a hole in the ground with a liar standing over it. So, and it's not quite that bad, but you do need to be skeptical because there's not so much scammers in the industry, but they're always trying to put their best foot forward, right? And they're always trying to promote and tell you what's good about it. And you have to look beyond what you're being told and what you may be reading and that sort of thing, and kind of look behind the scenes, look at the footnotes and start to question everything to see if it's really going to be a good investment. And so that's one of the big lessons among many that I learned from Louis. So, and as far as Mike Maloney, who's the founder of goldsilver.com, I went to work with him after leaving Casey Research. And, Mike's really he has the whole Hidden Secrets of Money video series, right? It's very popular movie quality productions. There's a dozen of them now, and the first one starts with the difference between money and currency. So the main lesson there is that money is not the dollar bill in your wallet. Money is gold because it's the best store of value, whereas the currency, the dollar bill in your wallet, is not a good store of value. We all heard the quotes of the dollar's lost 96% of its purchasing power now since the Fed was created. So whereas gold has lost no purchasing power over that same time period. So he really makes that distinction. And I think that'll be increasingly important as we go forward because of the fact that we're all in a fiat currency system now.
The series of The Hidden Secrets of Money is a great place to learn. I've personally watched it many times. It's interesting that you bring up the purchasing power and the holding power of gold. Recently, you put up a couple charts on your Twitter of real estate pricing versus gold and versus silver as well. So maybe share with us a little bit about what those charts showed and what the comparisons to the 1980s price levels could be.
So the idea there is if you want to try to participate in what we believe will be a wealth transfer, where real estate and stocks and other common asset classes decline in value while gold and silver increase in value. And if you can, to maximize that, you want to swap out your overpriced gold and silver someday for underpriced property, real estate, yachts, what have you. I have a really good friend in Cayman who he's planning on buying a very nice yacht because he believes those things are going to be the first to go in a serious depression and loss of purchasing power. So he thinks they're going to drop in value dramatically while his gold and silver increases in value dramatically. And that's kind of the idea. But as far as the real estate one goes, the peak was back in, looks like 2001, where it took 834 ounces of gold to buy the average price home in the U.S. Recently, it's been about 270, but the bottom was it only took 85 ounces of gold to buy the average price U.S. home back in 1980 when the gold price peaked. And the interesting thing there is real estate home prices were actually rising in the 70s, believe it or not, because of inflation. But the gold price had outpaced the rise in home prices so much that that ratio continued to drop, and it only took 85 ounces of gold to buy a home. For silver, it was even more dramatic. Back then, it took only about 1,500 ounces of silver to buy the average price home at silver's peak back in 1980. So, and now it's around 20,000, 22,000, somewhere in there. I don't have the exact number. I haven't updated that in a few months. But that just shows you 3 mint boxes of silver could potentially, at its peak, buy you the average price home if that ratio were to repeat as it did back then. So that's potentially very exciting. So I think, I don't know if it'll get that low again, but I think that's the direction it's going to go.
And when you say if it'll get that low, do you mean the gold to silver ratio or the silver to real estate ratio?
The gold to real estate ratio and the silver to real estate ratio, yes. So 3 mint boxes of silver is all it took back then to buy the average priced home. So think about it. I mean, real estate's, it's been pretty frothy here for a few years, right? And now, with COVID and all unemployment and all that stuff, it looks like real estate's going to roll over. Home values are going to roll over. And meanwhile, what are gold and silver going to do? Well, gold and silver are probably going to continue to rise and rise dramatically if you have a, 2, 3, 4 year time frame, which means that, the number of ounces of gold or silver that it takes to buy a home is probably going to fall. And so that'll work in our favor if you're a gold and silver owner.
So do you think, Jeff, in your opinion, that we could see close to what those 1980 ratios were? And what would the, let's say, inflation-adjusted price levels for gold and silver be if we're thinking about where those price levels would get to for that 1980s price level?
Well, that's the million-dollar question, right? We don't know if it's going to repeat. We don't know what the price is going to be or how long it's going to take to get there. But what I don't focus on is what it did in 1980. What I focus on is where we're at today. And where we're at today is we have numerous economic, monetary, geopolitical, fiscal risks just all over the place, right? And all the reasons that investors have been buying gold for the past few months, none of those have been resolved. None of them. And we've seen really no real-world effects of the currency dilution, the massive currency dilution. All we've seen is people buying gold in response to that. We haven't seen any serious monetary fallout, such as inflation. So, with all of that still ahead, even though gold is near its all-time highs, I think gold is definitely the place to be. And meanwhile, the stock market's overvalued by almost any measure. Even Warren Buffett admits that. Virtually any metric you use is going to show that real estate's overvalued and probably going to decline. So you buttress those things together, and it makes for a very opportune time for those ratios to fall and for gold and silver prices to climb. And really, is it gold and silver going up in value, or is it the dollar and other fiat currencies going down in value? So when you throw that into the equation, the fact that we're on a fiat currency system globally for the first time in recorded history, the risks are clearly to the upside for gold and silver, not to the downside.
So as we combine all these geopolitical, fiscal, and all those associated risks, do you I know Mike released a video recently on if we could see triple-digit silver, and what's your opinion on that?
Oh, yes, we easily could. I think the main thing to keep in mind with silver is, obviously, as I'm sure most of your audience knows, it's very volatile, and that's because it's a very small market. And because it's a small market, it doesn't take a whole lot of cash coming in to impact the price. And so when cash does start to rush into silver, the price is going to climb much more dramatically than it will with gold. What's that catalyst going to be? Probably inflation. If you think about it, what were silver's two biggest climbs in history? Well, one was in the 1970s when we had real inflation, runaway inflation, some would say. And then from 2009 to 2011, we had the fear of inflation. Everybody just assumed back then, myself included, that the currency printing and all that dilution that the Fed, and other central bankers did was going to lead to inflation. It didn't, but we had that fear, and so people were rushing into gold and silver. So I think there's going to be some type of inflation component in our future. That may be even starting now. We'll see. But if we see inflation, silver is I just don't see a scenario where silver doesn't take off and retest its old highs, which would be $50, and on its way to triple digits. I really think, and the thing is, I hope it doesn't actually get that bad. If we go to triple digits, $100, between me and you, I actually hope it stops. Because if it keeps going, if it goes to these $500 figures some people throw out, just imagine what kind of world we'd be living in then. That would imply that things are really, really bad, or we're in some type of hyperinflation, and that's very destructive and would hurt you in more ways than one. So I actually hope we don't get that high, but that risk is not zero either.
Absolutely. As you were saying, explaining a little bit about how small the market is, let's dig into that a little bit. You had an excellent presentation at VRIC that was earlier this year, I believe, and gave several examples about how small the silver market is. So could you give us a couple more of those examples?
This is one of my favorite topics because the silver market is small. And I think a lot of people know this, but I don't think they realize just how small it is. So just as one example in the talk you're probably referring to, at the end of 2019, Credit Suisse estimated that global wealth around the world was about $230 trillion. It's a little less now, although the NASDAQ is higher now than it was then, so it's probably still close to that figure. We don't know exactly how much above-ground investment silver there is, but, the average estimate out there, I think, is around 3.4 or 3.5 billion ounces. And now I'm excluding jewelry and industrial use silver and things like that. This is just coins and bars, physical metal that's investment grade. You multiply that times $18, that's $63 billion. So $63 billion for the silver, all the above-ground silver there is, versus $230 trillion in global wealth, and that means that global wealth is 3,650 times bigger than all the investment-grade silver that is currently available. So that just gives you one example of just how small it is. It'd be like walking up to an Olympic swimming pool and dropping a dime in the water. I mean, that's not an exaggeration. That's what kind of contrast we're talking about. Now, of course, all that currency is not going to come rushing into silver, but it doesn't need to. It would just take literally 1% of that, and it would just completely overwhelm the silver market.
One of your other great examples you have in there is, I think it's something like 5% of Apple's free cash, not even the total value of the company, just their free cash could buy the entire silver market, right?
Oh, more than that. They have, I think their Q2 is not out yet, if I'm not mistaken. Their Q1, they had $210 billion in cash, something like that. It was somewhere around there. If you add up the market cap of the primary silver industry, and we know there's just not that many primary silver producers where they're focused primarily on producing silver and the other metals are byproducts. There's just not that many of them. So Apple Computer could buy literally every share of every primary silver producer that exists with about 12% of its cash. Not the cash of the silver companies. every share of the silver company. So we're not even comparing apples to apples, right? It's apples cash. So they could buy every share of every silver producer you know of out there, the producers, not the juniors, and they'd still have 85% of their cash left over. That's how small the primary silver industry is. It's ridiculously small. It's minuscule. It's a rounding error. It's a nothing burger, whatever adjective you want to use. And, of course, Apple is probably not going to do that, but that's just one company out of thousands of companies. And then you throw in all the institutional investors and sovereign wealth funds and mutual funds and retail investors and central banks. I mean, this could get crazy, and it's just not going to take a whole lot of cash coming into the silver industry to really impact its price, whether it's for physical metal or the primary silver producers.
One of the other examples that you have on that video is the supply of M2 money and how small of a fraction that you could buy those silver producers with as well. And I wanted to ask you about that. Could you explain to us what M2 money is and give us the contrast of the percentage that it would take to buy those shares?
You know, I've not updated that recently. That figure I gave you earlier was for global wealth. So for M2, I haven't updated that in quite a while, maybe a year. But M2 is probably the broadest definition of money supply that not just the U.S. has, but other countries. So M2's, what we call M2 matches what other countries also have as M2 in the developing world. And I think that's the example of where you walk up to an Olympic-sized swimming pool and drop a dime in it, and that's what, M2 would be the pool water, and the dime would be the silver market. So whether, we're looking at global wealth or M2, it's really all the same. It's just an overwhelming amount of currency. And again, I'm not suggesting that, all of that or even a lot of it's going to come in. I think it only takes a small amount to really just blow up the silver market. And I think if we get inflation, that's exactly what's going to happen.
Another piece to the silver puzzle that we're seeing right now that you highlight is mine supply and even recycling supply falling. Can you tell us a little bit more about why that is?
Yeah, so mine supply for both gold and silver, but especially for silver, has been rolling over and it is going into decline. For silver, it's been in decline 4 years now, going on 5. But what's really interesting is when the CPM Group Silver Yearbook came out, I did a chart there that noted the changes in mine supply. And this 4-year period, 2017, 18, 19, and this year, this 4-year period has seen the biggest decline in mine supply in recorded history, this 4-year period. And that data came out before COVID struck. So it's only going to get worse. We know that at least 10% of 2020 silver supply, new mine supply, is not going to come to market. And it could easily be higher, especially if they shut down again. But regardless of that, silver, the reduction in silver supply coming from the mining industry is in its biggest decline in recorded history that we know of. And this is data going back to the late 1940s, early 1950s. I don't know if they have data before that or they just don't report it, but at least 70 years we know this is the biggest 4-year period. There's a lot of reasons for that, which would take an hour to discuss, but the interesting thing is that the 10 largest silver-producing countries in the world all are seeing less production for silver. That's been in decline since 2016. And the most interesting thing to me that I found from that research was that mines come into development and then they go into development and then they go into production, right? So when the silver industry, the primary silver industry, how many new mines do you think came online last year in 2019 that were a primary silver producer? If you want to take a guess, you think it was 10, 20, 5?
I would say less than 5.
It was 1. In the entire year of 2019, there was 1 new silver mine, primary silver mine.
Yeah, that's primary, right? Yeah.
Primary, right. But it's even worse with as dramatic as that is, 1 new mine that's a primary silver, operation came into production. That's crazy. 1. And that's, in 2019, the silver price was actually stable. So it's even worse, though, with the byproduct producers. So most metal, as your audience I'm sure knows, most silver comes as a byproduct. Well, the issue there is that these copper mines and zinc mines and lead mines and all these other ones that produce silver as a byproduct, their capex is projected to fall dramatically. It's already falling this year, and it's projected to continue to fall fairly rapidly over the next few years. So if they spend less on capex, which means they're spending less in development, expansions, operations and exploration, what are they going to produce less of? They're going to produce less silver. So not only do we have the primary silver industry struggling, we have the byproduct industry that produces 3 out of 4 ounces roughly also struggling. And so new mine supply from both sources is actually projected to decline fairly significantly, statistically significantly, over the next few years at least. And these are structural things. This is going to take a dramatically higher silver price to bring a lot of primary silver production back online or increase exploration or increase development. But with the byproduct producers, the silver price doesn't really incentivize them to spend more on development because their primary product is copper or lead or zinc. So if the prices of those metals are falling, which would be very easy to see in a depression, those mines are going to struggle and they're not going to produce more silver. They're going to produce less silver because they're producing less copper, lead, and zinc.
Jeff, do you know, let's just take uranium, for example. We can see the price rise all we want, but it's going to take 10 plus years to get new mines into production. Do you know what that timeline would be to get new silver production online?
Yeah, it's roughly the same for a lot of mining operations. It does take a decade. Some people think that's, how could it take that long? But it does, because from exploration go all the way through development, which is, your feasibility and your permitting and all your political stuff, and then you go into construction, and then you begin operations, and then when you begin operations, it doesn't mean you're at commercial production levels. That can sometimes take months or a year to get to that level. So all this takes time, and so that's why I say it's structural. So if, let's say, silver goes to $30 by the end of the year. Now, I'm not saying it will. I don't think it'll go that high, but let's say it did. $30. You think all of a sudden, almost every silver mine out there is profitable. They can make money. That incentivizes them. But guess what? They're not going to just run out and start producing metal. The reason is because they need to see a sustainable silver price before they're going to spend millions and millions and millions of dollars developing a project. If they think it's a one-off thing or it's just a spike, they need to see months and months and months of a silver price that's stable at $25 silver, $30 silver, whatever the case may be, before we're going to spend all that money and start the process of exploring projects and developing projects and expanding existing mines and hiring back geologists and hiring back mine engineers. That all takes time. It's not turning on a light switch. It's like a barge trying to execute a 3-point turnaround in a port. It's going to take a lot of time. It's not easy, and it's going to take a lot of time. Now, it'll probably happen, but that's because I think silver is going to go, higher, and I think it'll stay higher for a while. It is very volatile, so it could easily sell off again. But because these things are structural, bringing new supply online is not going to happen quickly or easily.
So let's turn a little bit, Jeff, to thinking about how to actually have the best leverage when this silver price decides to accelerate. You were speaking about you didn't want to get into gold panning. You wanted to get into actually making money from gold, as you were saying with your dad. So explain to us a little bit about how best to have leverage to the silver price.
Well, leverage is going to come through the miners. We know that. And, you'd probably want to start with the producers because the producers will move first. Now, we've seen a big jump in the juniors this year, right? And we can talk about that if you want. But the leverage comes because the gold and silver prices move a lot more than the price of computers or microchips or shoes or office supplies. Those things don't dramatically rise, in price that much. But the product that these miners sell, gold and silver, can rise that much. And so what happens is they're all working at the margins now. There are profitable companies out there, but many are just barely profitable, and some are unprofitable, especially in the silver space. So when you have a 10% move in the gold or silver price, all of a sudden you can see that company's earnings jump by 100%. That's not uncommon at all, and sometimes even more. You can see a company that's unprofitable go to profitable on just a 10% move in the gold or silver price. And then what happens to their leverage if they go, if the gold and silver price double? The leverage can get kind of silly at that point, can get into the thousands of percent. And I'm not going to tell you that's going to happen, but I think that's something I'm personally betting on. I think the leverage can be very dramatic, and I do think it's something that's going to come down the pike here.
So let's talk a little bit about the juniors and how you're seeing that. Is that more of a speculation play at this point?
It is, and I think it always is. So I'm a mining stock. I'm not a mining stock investor. I'm a mining stock speculator. And I think everyone who's going to buy juniors needs to realize that you're not necessarily investing, you're speculating. These are not heirlooms. You're not going to hold them forever. They're very volatile. We want to capitalize on that volatility, and I think we can, and I think we will, but you can't hang around forever. You have to watch them, and you have to learn to take profits, and you have to learn to make sure you buy enough of them. You have to take a Pringles approach. You can't just buy one, right? You have to diversify, a little bit. Obviously, you have to go after the best ones, which means the best management teams with the best projects and the best jurisdictions. So, but a lot of these have. It's kind of funny, the juniors that have doubled since their March low are kind of the losers because so many have tripled and quadrupled. And I mean, I'm sitting on two that have done 5x just since their March low. So, they've run up a lot. So you have to be a little careful here. I wouldn't run out and just load up on them right now. I would look for a pullback. But that's the kind of leverage you were asking about. That's a good example of the leverage right there, even though they're not in production, the juniors. But that's the kind of leverage you can get because they're also very small. Their market caps are very tiny. So just a little bit of cash coming in can be dramatic. So
perfect. Is there anything else we're missing to kind of complete the silver picture?
The silver picture, I think that's the main thing to be aware of. It's very volatile. You can't get shaken out. There will be pullbacks along the way. There always is. But I think ultimately we're headed a lot higher. And if you see headline inflation start to really spark up, like you're seeing headlines of it, in the nightly news or something like that, that's your cue that it might be last train out for the silver train. So you might want to, when you see that, I think you better get what you want.
Absolutely. You posted an article, you said it was one of the most fun articles you've ever written about the coming wealth transfer. And in it, you talk a lot about the inflation. So can you give us a couple tidbits from that article and tell us a little bit about it?
That article was a fun article to write, and it's sort of a fictional account of what a mania or parabolic rise in the gold and silver price could look like. And it's not all fun and games because even though gold and silver are rising a lot, they're rising a lot because all the uncertainty and the bad things that are happening around it. So you got both good and bad going on at the same time. But the good is you're actually protecting your lifestyle, your standard of living by owning gold and silver. And there will come a day where you'll wonder, well, should I sell now? Are we at a point where I need to sell some of this? And that's why I think it's going to be like it is buying now. So we buy in tranches now. I think we'll probably sell in tranches as well because, as the saying goes, nobody rings the bell at the top of the market. So I think it's important to learn how to buy in tranches now because you're probably going to sell in tranches when that time comes as well.
Is there some indicators that you're looking at to try and identify when we're maybe getting close to a top?
That's a great question. It's not a fixed price. Like, okay, we're selling everything when gold hits 5,000 or 10,000 or 3,000. Whatever. We're not predetermining that. It's what the gold or silver will buy you. I think that's the best way to look at it. If it doesn't buy you a whole lot, even though it's at $5,000, I probably wouldn't sell because it's not buying me enough yet. It hasn't peaked enough yet. So we're not trying to predetermine a price. It's what it's going to buy you. So it'll be a lot of ratio analysis. And the interesting thing is Mike Maloney has an insider program for those that qualify, and the bar is not high to qualify for. But he has a lot of indicators he'll be using, some of which are proprietary that he won't share with the public, but that will be signals to him to say, okay, this is a signal that it's time to begin to exit the industry. And he'll be sharing that with insiders, not publicly, just with insiders. So if anybody's interested in that, they can go to our website and goldsilver.com and look at the insider program and see if they'd like to do that. But I think that's the thing to focus on, is what it will buy you and what the ratio of gold and silver prices are to other things, not the prices themselves.
I think another piece of that, Jeff, that maybe some people could be worried about in a crash like that, or let's say inflation like that, is the risk of confiscation. And so could you tell us a little bit about if that's something that we're maybe going to need to worry about?
Well, the risk of that is not zero. I wish I could say that, but it's not. The risk is probably lower now than it was before because gold and silver are not part of the monetary system like they were then. They were a core part. They backed the currency. And so there was a large incentive for the government to want to confiscate the gold. The other reason I think the risk is low is because it just won't net the government much, whether you're talking about the U.S. government, I was going to say Canada, but they don't own any gold, but, or some other country that has gold reserves. It's such a small market that it's just not going to net them much cash. I don't know that they could even pay off 10% of their debt if they got a hold of every ounce of gold that's out there in investable form. It's just not going to do much for them, let alone try to back the currency. Now, a higher gold price would help with that. But so those are the two reasons why I think the risk is lower now than it was, back when they did confiscate it. But again, I don't think that risk is zero. I think there is, a reason to make sure you own some physical gold in your possession, close at hand, so you can convert it to cash if you need to. And, by the way, if we see gold getting to $5,000 or any of these other high prices, and confiscation becomes more of a topic that the governments are discussing, well, maybe that's one of our clues that it's time to exit, and sell before that happens. So that's always a possibility as well. That's a little tricky, but that's, something we'll be looking at the time if that becomes, a more realistic possibility.
Perfect, Jeff. Is there anything that you do a reasonable amount of these interviews, but is there anything that people miss and that you would like to talk about?
Well, I will say that, I am a gold bug and a silver bug, but I'm a temporary gold bug and a silver bug. I will be selling the bulk of it when that time comes, and we don't know when that is or what price that'll be, but I will be exiting the industry in large part, maybe not in full, but in large part because I want to capitalize and participate in the wealth transfer. I really believe that's going to happen, especially if we're right about where gold and silver are going at some point. I want to participate in that. I want to buy some undervalued, beachfront property somewhere, or, maybe some other real estate, or some, undervalued stocks, or maybe some personal things like my
new
friend who wants to buy the yacht. Yeah, so, a lot of things will be a lot more affordable. I think that gold and silver won't just keep up your purchasing power. I think they're going to overshoot. And I think when they do overshoot and they become overvalued, and I use air quotes when I say that, overvalued meaning relative to other assets, that it's time to swap them out. So I'm not going to stick around in the gold and silver industry as much as I love it, indefinitely, not forever. I may not sell everything, but I will sell a big portion of it so that I can participate in the wealth transfer.
Excellent. Lots of sound advice there, Jeff. Can you share with us where to find more information and your articles?
Sure. It's at goldsilver.com pretty easily. You just look on there at our blog, and Mike does a lot of videos. I do a lot of the writing and research for articles, so all of our original stuff is there. So it's really been a fun thing to participate with the company and generate a lot of these, articles and interesting research and that sort of thing, and they've been very supportive of the things that I've wanted to do. And as far as the mining stocks, we don't have a newsletter for that, but I did kind of agree when I got on Twitter that I would reveal what my buys and sells are there. So if anyone's interested in following me there, it's at The Gold Advisor on Twitter, and I do reveal what my personal buys and sells are there. Not advice, of course, but but I do say what I've been buying and selling.
Excellent, Jeff. Thanks very much for your time today.
Great. Let's do it again sometime.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?